Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If we get into a period where global investors see the U.S. as a risky place to put money and we see a wholesale move out of U.S. assets, you're going to see a decline in treasuries, a decline in stocks, and a decline in bonds at the same time. The primary benefactor in that type of environment will be the euro and possibly the yen, not as much from our standpoint, but it will be the euro because it's the key dollar alternative. And we saw that today. The euro was the strongest of the major currencies today on a move out of U.S. stocks, out of U.S. bonds. They closed okay, although I think the 30-year got hit pretty hard today. So we saw a bit of a triple whammy out of the U.S. stocks, and it goes to this background that the U.S. government is doing everything they can to weaken the U.S. financial structure, in our opinion, and global investors are starting to get tired of it. We saw a nice risk bid in gold today also with the triple whammy that hit U.S. stocks, bonds, and currencies. So as much as I just said here, a lot of that is invalidated near term, but you have to be open to that. And if you understand the other correlations, and all of a sudden you see in the shorter term time frames the correlations breaking down the clean, clear-cut correlations we've seen in the past, you have to say to yourself, what's changed? Use some logic and think, okay, maybe there is a fear move out of U.S. assets. So that's what we have to be open to. So that changes the picture again, and we think the hiding place in this environment will be the euro, especially because the euro has lagged a bit on this risk appetite move behind the commodities, currencies, and behind the British pound. So just be open to a change at any time, and don't panic if it changes. Just think about it and think about your positioning. And I will pass the baton over to Steve, and then we'll take some questions after Steve is done.
Jack, thanks again. Great presentation. I learn a lot every time that you're on. Really appreciate it. I just took a couple of screenshots today, and Jack was talking about this, and I think all you know that, what's been going on the last 4 months or so, the dollar has been weak. And so here are some shots, just some charts of the Canadian, the Aussie, and the Euro. And what's important is that at the ISE, we trade dollar relative. So if you're looking at the Canadian dollar, it's U.S. dollar divided by the Canadian, or the Aussie, which is the U.S. dollar again by the Aussie. So it's going to be a little bit different when you're looking at the Aussie, the Euro, than you're used to. But just think of it as what is the dollar worth, and the dollar's worth less recently. So you can look at that upper pane. In fact, the bottom pane is that red line, and I'll just take a little pen so you guys can recognize this. Jack mentioned about perception. Well, there's a lot of ways to define perception, but here I can have this red line is telling me what the options, how expensive is it to hedge. Now, that doesn't mean that just because it's relatively cheaper that you should be buying so many options, or when they're expensive, like here, that you should be selling options. It's just a way to understand risk, another way to quantify risk. There are probably a lot of different ways that you guys, all the attendees, look at risk, and Jack's giving you probably some new ones. Another one I'd like you to think about is the implied volatilities, and as Jack said, I'd concur as far as the Aussie dollar. It had the highest volatility last fall, even higher than the U.S. dollar against the Japanese yen. So that's sort of, at least in the options market, that's been the leader as far as the risk is concerned, one way or another. So you take a look at this, and so the symbol that you would type into your equity options broker would be CDD for the Canadian dollar, AUX for the Australian dollar, and EUI for the euro. And again, it's a dollar relative convention. So what is the dollar worth? So going on to the next page. Oops, let me just some option quotes, and as Jack said, there are so many different ways to play this. So you can take a look, and let's just say, I'll give you a couple views. Let's say that we had Jack's view that the dollar was going to sell off. Why would it sell off? Well, green shoots, the idea that the commodity currencies were going to strengthen, crude would rally. Well, if you had believed any of that, here are some put options. And these are September options. This was taken about 3 or 4 hours ago. So you could see that as we move down the strike prices, they get cheaper. Why? Because you have the ability to sell the U.S. dollar at lower prices. So that technically each strike is based on probabilities, gives you a different risk reward. So at 114.35, I could look out into September and buy an at-the-money put for 343. By the way, I didn't check, but I assume that this option is worth more now than it was 3 or 4 hours ago. Alternatively, though, any of these calls that if I would have been thinking that the U.S. dollar was going to rally, so it's U.S. dollar here. If the dollar is rallying, that's a little sloppy, but if the dollar is rallying, then I'd be looking at calls. If the dollar is selling off, I'd be looking at puts. So what happened today is all these puts probably gained in value, and the calls were down in value. Again, that is a way to look at it. So if you believe in green shoots, well, then you're going to be looking at the puts. If you believe that the U.S. dollar would rally back, green shoots is false, then I would be looking at the calls. So another way to play it, again, this is, of course, the riskiest. In fact, the bid-ask spreads are the widest here for one major reason, is that it's hardest to actually quote this because it is the riskiest pair. Again, if you believe the green shoots theory, then you're going to be looking at any of these put options because you believe that the U.S. dollar is going to sell off. So it's, you may say, okay, well, here we are at 129.95. Again, this was early this afternoon. What could I do? I could buy a slightly out-of-the-money put for 320. My guess is that put is probably worth a bit more than that. If you did not believe in the green shoots, you wanted to take an alternative view. In fact, the options give you a great way to limit your risk. Remember, if you buy an option, whether it's a call, which means you believe that the dollar would rally, or a put, which of course means that you think that the dollar will continue to sell off, you could only lose, your maximum loss is the premium that you paid. So if you believed in this trend that you thought it would continue, well, you'd probably be looking at some put options. If you thought maybe we're going to hit a bottom at some point, well, then you're thinking call options because the dollar would be worth more. And lastly, we take a look at the euro. If you had a view on the euro, well, these options are going to be relatively cheaper. The volatility is a bit less. The U.S. dollar does not move as much against the euro. That doesn't mean we couldn't have a huge move. In fact, if you believed in, again, global rebalancing, as Jack's been talking about, and you thought that many, many months from now, as the U.S. consumer actually starts to save more money, if he's right, if Jack's right, one of these call options could make sense. If the dollar rallies back, the dollar rallies back up here to 81, well, so these 78s or the 81s are going to make sense. I looked at the December options today. Of course, if you believe that the trend was going to continue to the downside, that the dollar was going to weaken even further, well, these puts, and you could go, obviously we traded below 66 last year, so these 66 puts, which are only trading at 68 cents, and just so you all know, 68 cents is 68 times 100 is $68, not including any commission. So lots of ways to look at this. Again, if you're looking at the puts, that means that you're bearish on the U.S. dollar. If you're looking at the calls, that means you're bullish on the U.S. dollar.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.